you're a client of ours, as accountant or bookkeeper, and you're listening to this, I'm sorry. And I guess client, if you're listening to this, here's why after you sent this to your accountant, they're going to ask you for more money. Because before, recognizing your revenue, if it was cash-based or even if it was accrual-based, was as simple as flipping a setting on inside of QuickBooks or Xero. Now, things have gotten a lot more complicated, especially if you're trying to do this really accurately based on earned value. And in the case of QuickBooks, candidly, from what I understand, I mean, I'm not going to sit here and claim to be a bookkeeper or an accountant, but based on what we've experienced working with accountants and what we've seen getting inside of QuickBooks, it doesn't really handle this sort of bespoke revenue recognition very well at all. When you try to move away from using invoice dates to do revenue recognition, QuickBooks just kind of like doesn't have a great answer for that as it stands today. And so what you end up with is a process where at the end of the month, you have to do a lot of journal entries. And what that means is, as an accountant or as a bookkeeper, they have to go in, and often what's happening is they've got to take all the money that you got paid and put it on your balance sheet as deferred revenue. And then for every project or client, go through and say manually, we're going to move this much money from the balance sheet to the profit and loss statement for this month. And they have to be keeping track of like how much has been moved, how much is left, right? And so compared to what it used to be, which is just make sure all the invoices are in there and you know, that's it. This is a significant increase in the amount of work that they have to do. And to a degree, the same is true on the expense side. So that is something that you need to be aware of, is generally accrual accounting, especially if you're doing it well with a professional that knows what they're doing and it's tied into your delivery system, it's going to be a lot more expensive than cash-based accounting.
I had one agency where they were at a point of either going out of business or trying to sell, but they had tons of revenue on the books that they hadn't actually finished yet, which should show up as a liability, but won't if you're not handling your books properly.
Well, yeah, and you're touching on, yes, a lot of the additional reasons that this is useful. So not only does it give you a better management lens on the business, but it can also help you really identify the difference between the cash profitability of your business and the accrual profitability of your business. Mm-hmm. And again, this can be a really important trap. And unfortunately, we've seen some clients and some friends of ours fall into this trap where they're wildly profitable on a cash basis, even though the business itself was not profitable at all. Because, you know, they kept getting new business. So they kept having a check for the new client come in. And, you know, Ponzi scheme is not necessarily like the best way to describe this, but in a sense, it's like the newest clients were paying for the old clients, were often not profitable, in some cases losing money, but they never really had to face that fact because on a cash basis, everything looked fine because there was just enough new money coming in every month. So it does sort of help with that.